The whole theme of this week, and what we're really trying to answer today, is whether the ECB's decision to put more money into the European banks is a wise one, whether market participants are buying into it or whether they're skeptical. And with that in mind, we're bringing you Axel Merk. Axel's fund, his foreign currency fund, is in one of the top performing groups in all funds so far this year, top 7%. Axel, we're glad you're here with us. You're a frequent guest here on Street Smart. A couple of weeks ago, you were positive of the euro, and then you reversed very quickly. You said you didn't like what was happening, and you've been dead right. The euro now is trading down to about two-year lows. What are you doing right now?
Well, generally speaking, hi Adam, hi Lisa. We are generally speaking more long-term oriented, but when policymakers throw around trillions, have rapid, aggressive moves, we obviously have to react. We turned more negative in recent weeks, and then that accelerated as the ECB turned more dovish, as the Federal Reserve may be doing more easing, finding more opportunities elsewhere, and then obviously we had the turmoil end of last week over the weekend. And again, we had a game changer now with the liquidity being provided. Let's keep in mind that we do not have a liquidity problem. We have a solvency problem. And the market was pricing in a liquidity problem last week. That's what we reacted to or tried to act ahead of time preemptively to. And we had actually then increased our euro holdings again earlier in the week. The liquidity that's being provided can keep a banking system afloat. Look at Japan in the 90s. A zombie banking system kept afloat. What happens in that sort of environment is that there's less economic growth because banks are undercapitalized. For the euro, that is maybe even a neutral long term, because in the eurozone we don't have a current account deficit. In the US we have a current account deficit. US is desperate for growth to support its currency. The other extreme, Japan, current account surplus, less economic growth is even a positive for the currency. So a lot of things happening right now. We had been lowering our euro holdings. We've moved more defensively to the yen and a couple of other things, but we just have to play it by day by day these days, how the currency how the policymakers are acting.
Now, Axel, let me ask you, was the ECB's back against the wall? Did they have to say that they were going to provide liquidity?
Well, of course, we are not in 2008. The central banks and the ECB in particular is holding the feet to the fire of the policymakers. So they're just buying a tepid amount of sovereign bonds. Similarly, for the banking system, they want to do enough to keep the pressure on for them to raise capital. But of course, they want to keep the system solvent, liquid, and they want to keep things moving. And in 2008, the problem was that we had commercial banks around that couldn't access the Federal Reserve or other central banks. Now we have only commercial banks. Those can be kept afloat. They'll do anything, and indeed the facilities provided ensure that they're not going to be a funding crisis at the end of the year. And so, of course, unfortunately, the banks, as a result, will resume to business as more normal, and we have to wait for the next crisis for them to raise more capital. It would be very nice if the banks finally took the message and decided to raise capital in earnest.
Axel, I'm taking a look at the one-month return for the fund. It looks like it's down about 2.39% at the moment. But you have changed some of your weightings. I know you're going a little overweight the Australian dollar, the Canadian dollar, the Norwegian krona, as well as the New Zealand dollar. What is it about those currencies you like, and what was it that impacted performance over the last month?
Well, sure. Lots of cross-currents happening right now. In Australia, we are getting ready for another easing program at the Federal Reserve. We don't think it's necessary. We don't think it's good. But if indeed something is announced, the Australian dollar should disproportionately benefit. Having said that, consumer sentiment in Australia isn't particularly good right now. So we may even like the New Zealand dollar a little bit more. They have been reluctant in raising rates, the New Zealand dollar being the best performing currency today. And on the other side of the commodity spectrum is Canada. Canada is in a commodity block, benefits from the reflationary efforts in the U.S. Having said that, the Bank of Canada is always reluctant to raise interest rates as these things happen. If you look at what the alternatives are in Europe, many people are talking about the Norwegian krone and Swedish krone. We like them, but keep in mind that they're more volatile. And so we've been offsetting our move into those currencies with a much bigger yen exposure. We have the yen as high as we had it in 2008 as a defensive mechanism. Note, it's not U.S. Treasuries we're fleeing to, it's the yen we're fleeing to. And that is a defensive move. And so a defensive move obviously is also designed to keep any volatility down on the up end and on the downside.
Hey, Axel, it's Adam. What about the dollar? Do you like the dollar or do you not like the dollar?
So they will say
It always depends on what you hold. I much rather hold a German T-bill than a U.S. money market fund. U.S. money market funds continue to be overexposed to commercial paper issued by European banks, and that's, by the way, why there's a funding problem, or one of the reasons is that they've been getting a lot of scrutiny, including from us, and as a result, they've been paring back their exposure, and the European banks, surprise, surprise, have higher funding costs. We don't like the U.S. If you look at what's happening, not just next week at the Federal Reserve, look at the transitions happening at the Fed. The hawks are retiring. The new faces on the scene will be more dovish. We're going to have only one hawk next year on the Federal Reserve. Take into account then that the recovery is going to be lackluster, that there's the so-called slack in the economy, and add to that that the latest FOMC artificially depressed the yield curve, giving the Federal Reserve the excuse to print more money because it appears now that inflation expectations are low yet again. And so weigh that versus the rest of the world that reacts to high commodity prices, unlike the Fed where all these things are transitory. And you've got to have a long-term cautious view on the dollar. And our view is not so much is the dollar going down, but is there a risk of the dollar going down? And if so, how do you take that into account in your portfolio allocation?
Well, Axel, on that note, you were talking about taking a defensive position. You like the yen for that. What about gold? I noticed you actually trimmed your allocation recently.
Yes, we like gold as a long-term holding. We've had it between 5 and 15% over the years. We're now more towards the lower end. What we don't like is if the volatility in gold is lower than its historic norm. Just as in any other asset class, we wouldn't like that either, because then the momentum players come in. So we've been trimming down our gold holding as the gold was going up, and as a result, we weren't hit in the recent volatility as much as we would have otherwise. But long-term, we like gold. We have a global debt-to-GDP ratio in the OECD countries at over 100%. That means that inflation may very well be part of how policymakers try to resolve these issues, and gold will continue to benefit in that environment, in our view.
All right, Axel, thanks so much for joining us. Appreciate the insight here on Street Smart. That was Axel Merk.